Have you heard what's happening in Japan? Over the past few weeks, one of the world's largest and most stable financial markets, the Japanese government bond market, has erupted into a level of volatility we haven't seen in decades. Now, you might be thinking, that's in Tokyo? Why should I care? Well, this isn't just a local event. The ripples are already being felt across the globe, including right here in the United States. This could impact everything from your mortgage rate to the value of your retirement account. So, before we get into why this matters so much, let's break down what's actually going on. Japan has one of the highest levels of government debt compared to its economy in the developed world, talking over 230% of its GDP. For years, this massive debt was no big deal. The Bank of Japan kept interest rates at rock-bottom levels by buying up huge amounts of its own government bonds. This kept borrowing costs super low, but that whole system is now under pressure. As inflation started to creep up worldwide, markets began to question how long Japan could keep this up. In January 2026, this pressure finally boiled over. Yields on Japan's long-term government bonds surged sharply. At the same time, yields on their 30- and 40-year bonds hit the highest levels in over 3 decades. This wasn't a slow, gradual change. It was a rapid spike. As investors dumped long-term bonds, they were worried that new government spending plans, including big tax cuts, would make Japan's already huge debt problem even worse. What's really shocking here isn't just that yields went up, but how quickly it happened in what was supposed to be a super stable market. Reports suggest that even small amounts of selling, talking just a few $100 million worth of trades, were enough to cause a massive repricing of Japanese bonds. It's like a tiny ripple causing a tidal wave. Okay, so a bond market on the other side of the world is shaking. Why should anyone outside of Japan pay attention? Well, there are 4 big reasons. First, Japan plays a unique and massive role in global money flows. For decades, Japanese investors, like their huge pension funds and life insurance companies, have been some of the biggest buyers of foreign debt, especially U.S. Treasury securities. Think about it, when yields in Japan were practically zero, it was a no-brainer to borrow money in yen at a low cost and invest it in higher-yielding U.S. assets. This created a constant, strong demand for U.S. Treasuries, which helped keep our interest rates lower and markets running smoothly. But now, as Japanese bond yields rise, that entire dynamic starts to go into reverse. Higher yields at home make international bonds, including U.S. Treasuries, look a lot less attractive. Why take the risk of investing overseas when you can get a decent return right in your own backyard? Some analysts estimate that if Japanese investors decide to pull even a small portion of their money out of U.S. government bonds, it could lead to the selling of as much as $130 billion of U.S. Treasuries just to rebalance their portfolios. That's a huge amount of selling pressure. The second reason is the direct spillover effect on U.S. Treasury yields. Global bond markets are all connected. When yields spike in one major economy, investors everywhere start to reassess risk and returns. In mid-January, we saw U.S. Treasury yields climb right alongside Japanese yields. This happens because global investors are constantly comparing different government bond markets. If one starts offering a higher return, it puts pressure on others to do the same to stay competitive. And higher Treasury yields here in the U.S. have real-world consequences for all of us. It means higher mortgage rates, making it more expensive to buy a home. It means higher borrowing costs for businesses, which can slow down investment and hiring. It also means the U.S. government has to spend more just to pay the interest on its own debt, squeezing the budget for other important things. Even a small amount of pressure from Japan can significantly tighten financial conditions here. Third, we have the unwinding of something called the yen carry trade. This has been a popular strategy in global finance for years. It's pretty simple. Hedge funds and other big investors borrow money in Japanese yen, where interest rates were super low, and then use that money to invest in higher return assets elsewhere, like U.S. stocks, bonds, or commodities. It was like getting free money to go shopping with. But as Japanese interest rates rise, the appeal of this trade vanishes. The cost of borrowing in yen goes up, erasing the profit. When these carry trades unwind, it happens fast. Investors are forced to sell the assets they bought with that borrowed yen to pay back their loans. This could mean a wave of selling in US Treasuries, stocks, and other riskier assets, adding even more downward pressure on prices. And finally, reason number 4 is what this signals about overall risk sentiment in the global economy. Economists often call bond markets the canary in the coal mine. They're an early warning system for economic trouble. A sharp and sudden repricing of long-term debt, especially in a market as big and historically stable as Japan's, is a major red flag. It tells us that investors everywhere are fundamentally rethinking their assumptions about monetary policy, government debt, sustainability, and where interest rates are headed globally. Now, does this mean the US market is about to collapse? No, not at all. No serious economist is predicting a US default or a sudden crash because of this. But it does signal a period of rising risk and a major rebalancing of global capital. Money is starting to move in different ways than it has for the past decade, and those are conditions we need to watch very carefully. To put this into perspective, the last time global bond markets saw this kind of simultaneous stress was during the 1994 bond market crisis. Back then, rising interest rates in the US triggered a sharp sell-off that spread across the world. Today's situation is different, but the core lesson is the same. In a connected world, financial shocks can travel across borders with surprising speed. So, to wrap it all up, the stress in Japan's bond market is, just a local headline. It's a global financial event with clear and direct links to US markets. Rising Japanese yields could change who buys US debt, directly influence our own interest rates, and reshape the flow of money around the world. While this doesn't guarantee a crisis, it highlights just how interconnected our modern financial system is. A shift in one major economy can have ripple effects that reach far beyond its own shores. By understanding these connections, we can all get a better sense of the risks and opportunities in this fast-changing financial world. Thanks for watching, and if you found this helpful, be sure to like and subscribe for more insights. See you next time.